Strong earnings from Microsoft, Amazon, and Alphabet reinforced the AI narrative with robust cloud growth, confirming that heavy investment is translating into real revenue. Yet the positive technology momentum is being overshadowed this morning by a sharp rally in oil prices, pushing inflation expectations around the globe higher and complicating the outlook for central bank policies. The Fed kept its rates unchanged yesterday as expected, but internal divisions over the timing of future cuts underline growing uncertainty as markets reassess the path ahead. While the European Central Bank and the Bank of England will announce their latest monetary policy verdicts today, with the same worries spinning around the policymakers' heads. Rising inflation with no end in sight in the Middle East mess. So welcome to Swissquote's Daily Market Talk. It's Thursday, April 30th. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So we had a busy after-hours news flow with Meta, Microsoft, Amazon, and Google all reporting their first quarter earnings after the bell yesterday, and the results were pretty much okay, to say the least, except for Meta. Because the first three, Microsoft, Amazon, and Google, posted strong growth for their cloud divisions as they decided to bag multiple AI models, which diversifies individual risks. Amazon, for example, posted its fastest cloud growth in more than 3 years, spending their increased past analyst expectations, but the encouraging growth took the upper hand. The share price fluctuated between gains and losses for a while, but bulls finally gained over the bears, and the share pulled out nearly 3% jump post-earnings. Google, on the other hand, went straight up by 7% in the after-hours trading after beating expectations, while Microsoft's Azure posted a 39% growth in the first quarter of this year as a confirmation that they're turning the massive AI spending into real revenue. The after-hours price action was mixed at Microsoft, leaving Microsoft pretty much flat. Meta here was a dark spot, really, because it slumped on a single move around 7% in the after-hours trading after announcing more spending. The company now projects to spend between 135 to 145 billion US dollars. To do what? Well, for its own ecosystem. And the problem is, Meta is a single bet, really, spending on itself, whereas the former three hand out computing power and chips to others to bet on the idea that AI is getting bigger. So at this point, Meta has become a riskier bet. It is not diversified and it carries higher risk than its major peers. I mean, it's carrying its own risk. And at a time competition is rising pitilessly, it is probably not the safest place to be. Voila. But overall, things are going quite well for the AI exposed stocks. The cloud revenue growth actually confirms that the AI adoption is happening, and it is happening quite fast as the industry leaders are telling us, and later will continue to back the chip makers as well. In the stance, Kospi rose to a fresh all-time high today before giving back gains as Samsung announced mind-blowing results. If you're sitting, I will start citing them. The company reported revenue growth of 69% compared to the same time last year. Net profit increased 474%, and operating profit soared 756% year on year. 756%. All thanks to the rise in memory chip prices due to the memory chip shortage and AI demand. Alas, despite encouraging tech news, Nasdaq futures are down by around 0.22% this morning, overshadowed by the fresh rally in oil prices. Because indeed, US crude is being aggressively bought since yesterday, since Donald Trump rejected Iran's proposal to lift the naval blockade there, which could have brought Iran to the negotiation table and possibly paved the way to reopen the Strait of Hormuz. But now Trump wants Iran to come to the table before it lifts its blockade, and Iran says it will not negotiate as long as the blockade is there. So they're turning round and round and round. Result, US crude rocketed nearly 9% yesterday and has extended its gains above the $113 per barrel level at the time I'm talking here this morning. Brent is also pushing above the $113 per barrel level this morning. And high and rising energy prices push inflation expectations higher around the globe and make global central banks increasingly uncomfortable. The Fed yesterday left its interest rates unchanged as widely expected, but said that developments in the Middle East are contributing to a high uncertainty about the economic outlook. Fair enough, there's nothing surprising there. What was unusual, however, is 3 Fed members opposed the post-meeting language that the central bank would eventually resume cutting the interest rates. They understandably insisted that it was too early to talk about cutting the rates again when inflation outlook remains so cloudy and is worsening by the day. So that thinking makes sense, but it will also make the Fed's credibility harder when Kevin Warsh, who supports the idea of lower interest rates, will take the helm of the Fed in May, probably as he is now expected to be nominated. Alas, after yesterday's Federal Reserve meeting and the fresh spike that we see in oil prices, activity on Fed funds futures now stopped pricing any interest rate cut this year in the US. The probability of a December cut is now around 4%. Voila. So the US 2-year yield, which also captures the Federal Reserve rate expectations, rose to 3.94%, pushing the US 10-year yield to 4.43%. Today, the European Central Bank and the Bank of England are also expected to announce no change to their monetary policies, to their rates actually, but the rising inflation risk in Europe will keep the possibility of rate hikes on the table for the remainder of this year, unless the war in Iran stops or growth slows enough to tame the energy price pressures, the so-called demand destruction, remember, which happens when oil prices become too expensive for businesses and people to buy. In the meantime, the US dollar gains along with the rising oil prices, as you need more US dollars to buy the more expensive energy. But the US dollar's long-term outlook is weakening by the day. Here is the broader issue. The Iran war already costed $25 billion to the US government. And given the absurd diplomacy in place, it will cost more. Meanwhile, the US debt is rising with a big and beautiful tax bill, with politicians willing to add capital gain tax cuts into the mix, and the US government is also obliged today to refund the illegally collected import tariffs last year. The US debt, on the other hand, is about to hit the $40 trillion mark very shortly, and more worryingly, interest payments have now surpassed defense to become the 3rd largest spending category in the US, behind only Social Security and Medicare. That ultimately means that growth in the US is being compromised. And it is a serious problem when your debt is so high, because the debt held by the public is currently almost equal to the nation's GDP. And the CBO now projects it will rise to 120% of GDP within a decade, and potentially to 131% if tax cuts are made permanent. And global investors hate what they see, meaning that the replacement of US treasuries will continue, perhaps in favor of gold. In conclusion, gold dips are still interesting to buy for long-term investors, and that's what the global central banks are currently doing. According to World Gold Council's latest report, central banks bought a net 244 tons of gold in the first quarter of 2026. That was the fastest pace in over a year. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.